Hi, welcome back to my class. This is the risk, return, and the capital asset pricing model lecture series part 1. And in this class, I'm going to discuss about the return on investment, risk and return on individual security as well as for the portfolio, different types of risk and the efficient portfolio, and then portfolio diversification and risk. So let's get it started. After watching this lecture video, you should be able to know how to calculate rate of return on an investment, explain and calculate the expected return and risk for an individual security and for a portfolio. Explain and compute covariance and correlation. Explain the difference between standalone risk and risk in portfolio context. Understand the effects of diversification on portfolio risk. Discuss the difference between diversifiable risk and market risk, and explain how each type of risk affects well-diversified investors. Understand the trade-off between risk and return. So these are the main objectives I would like to achieve through this lecture. So let's briefly talk about the rate of return on an investment. So basically here I'm talking about return on a stock because if you know how to compute rate of return on one type of security, you can use the same concept to compute rate of return on other different types of securities. Okay, so rate of return in this example here, for example, if you bought a stock for $35 1 year ago, and then you got $1.25 dividend, and now the stock is trading for $40, or you sold the stock for $40. So what is your percentage rate of return? Okay, so here we have two parts. So these are basically dividend component. So basically income you receive during the holding period, and then the price change. Okay, so we have two components. It is called dividend yield. Dividend yield equals to dividend divided by the original price or investment, and then capital gain yield equals to current price minus the original price you paid and divided by the original price. That's going to give us capital gain yield. Okay, so you add these two types of yield together, you're going to have total rate of return. Okay, or you can put here dividend, and you can put here $40 minus $35, and you divide the whole thing by $35, you're going to get rate of return at 17.86%. And you can use the same knowledge to compute rate of return on other types of securities. Okay, holding period rate of return is basically rate of return, total rate of return from holding an investment for a specific time. If you want to compare this return to different securities, you have to find out annualized rate of return. Basically, holding period rate of return and the rate of return I just showed you is similar. Okay, one of the advantages of holding period rate of return is is calculated on per dollar investment basis, so it's not on time basis. Okay, so it is easier to understand. Okay, it's a basic measure of return for a particular investment. But the problem with this one is, if you want to compare different types of return in different investment, it's difficult to do that. So you have to find out your annualized rate of return. You can use this formula and find annualized rate of return. You can also, here is an example. You can use this example to find holding period rate of return. So basically, your holding period rate of return here is, because you have year 1, 2, 3, 4 different rate of return. So each rate of returns, 1 plus each rate of returns, multiply each of them minus 1, you're going to have 44.21% holding period rate of return. Okay, if you want to know what is your annual rate of return, we have different ways of doing that. We can use arithmetic average, which is basically the mean, basically your number of returns divided by number. So you count the numbers and you add all those numbers and divide by n. That's going to give you your arithmetic average. So basically it's average or mean. So arithmetic average is the sum of the series of numbers divided by the count of that series of numbers. So in that example, we have 10, -5, 20, and 10%. So add them together, it's 40, divided by 4 is 10%. Geometric average, on the other hand, is an average compound return for period over multiple periods. So geometric average will be less than the arithmetic average unless all the returns are equal. So in this case, these returns are not equal. Therefore, it's going to be a little bit less. So let's compute that the geometric average. So basically, you are using the same holding period return formula here, and you raise to 1 over n, okay, and do -1. So you have holding period rate of return is 44.21%. So raised to 1 over n is 0.25. So if you do that, you get 9.85%. So this is geometric average. Okay. So the main benefit of using geometric mean is, actually you don't need to know your actual investment. So basically you can get, very comparable numbers. Apples to apple comparison is easy using this geometric average. Which one is better? Well, it is, arithmetic average is overly optimistic for long horizon, whereas geometric average is overly pessimistic for short horizon. Okay, so these are the difference. So it just depends on which one works best for you. Which one is better. It's you can make a decision based on your situation. This is here. I just want to briefly talk about historical return. These are the 5 major financial instruments in the US. Okay, so large company stock, the average return during 1926 through 2007 was 12.3%, with 20% standard deviation. So risk was 20%, return was 12.3%. And small stock had 17.1% with 32.6% risk. Treasury bill had 3.8% average return with 3.1% standard deviation. Well, treasury are one of the things we use as a measure of risk-free assets. So maybe you're going to be wondering why this 3.1% standard deviation. It's basically this one is the change in that rate. Okay, so for example, rate is from 5% to 3%, or sometimes 5% to 6%. So that's the change in the rate. So that's how you get the standard deviation. But treasuries are basically risk-free asset. They do not. They are not completely risk-free because there is inflation. So if you make 3.8% and the inflation is 3.1%, so basically you are making only 0.7%. So treasuries are not completely risk-free, but in the sense, you put $1,000 in treasury, and you actually know you're going to receive $1,000 plus some interest. So in that sense, treasuries are risk-free asset we use in finance. And standard deviation, as you can see here, higher the standard deviation, you have lower the probability that average return, expected return is going to be close to the mean. So you see this is the mean, and then if you see a lot of high deviation, that's a risk. Okay, and I'm going to talk about risk later on. So let's plot using this historical information. Now we just talked about. Let's plot this risk and return in this graph, and if you do that, as you can see, this is annual standard deviation. This is annual average return. Okay, so when you plot risk and return using the historical information for this major financial instrument in the US, you can see that as risk goes up, return goes up. So what can you conclude? We can conclude that there is a positive relationship between risk and return. Okay, so if you have higher risk, you have higher expected return. on that investment. So risk aversion is another important thing. Risk aversion basically, is how investor treat risk. Some people do not like risk. Some people they love risk. So if you are risk averse, means you don't like risk. Investor dislike risk. Risk aversion means. Okay. So investor assume that investor dislike risk and require higher rate of return to encourage them to hold higher risk securities. Okay, so if you since the investors are risk averse, to encourage them, to persuade them to buy high risk security, there should be higher return. Risk premium is basically added return resulting from the extra risk. So if you have additional risk, the risk premium should go up. Okay, so in other words, risk premium is the difference between the expected return on a security or a portfolio and risk-free asset. Okay, so this one is often called risk premium. So the difference between expected return on a security or a portfolio and risk-free asset. Okay, that's the risk premium. And risk premium serves as compensation for investor to hold riskier securities. So you know that investors are risk averse and they need compensation to take extra risk. Okay, so if you have security with higher risk, you should have higher return. Okay, if you use the historical information to find the difference, because as you know that expected return, difference between expected return and risk-free asset is risk premium. If you use historical or realized return, actual return, and the difference between actual return and risk-free asset is we call excess return. So only the difference here, risk premium and excess return, is basically risk premium is based on expected return and excess return is the difference between actual return and risk-free security. Okay, so if you look the historical average return we just talked about, if you look large company, so the average return was 12.3% and treasury had 3.8%. So the difference here is 8.5%. This is average excess return. Okay, so if you find this difference using expected return, that is called risk premium. Okay, so that's the difference. So before I start working on risk and return, let's watch this short introduction on this risk return.
The critical thing here to recognize is that investors do not like risk. And since investors don't like risk or are averse to risk, then riskier securities have to promise higher rates of return than less risky securities. Now, you can think about this. If you had your choice between a certain $1 million and possibly maybe $2 million, but maybe nothing, you'd probably take the certain $1 million. That means you're risk averse. And most investors are that way. So we are going to look at how much the additional how much risk causes the rate of return to increase. But before we do that, we have to think about how do you measure risk? How would you go about measuring risk? Well, if you think about a security that offers the possibilities that you could get zero or that you could get a very high rate of return on it, you have a wide range of possibilities, that would be a risky security. Another security that the range is quite narrow, you could make between 10% at the bottom or 12% at the top, not much of a range, that would not be a risky security. So you could think about the difference between the high and lows as being as a measure of risk. Now that would be measured by this thing we call the standard deviation, which we get into in the chapter. But then another critically important thing that you've got to recognize in this chapter is something called diversification. You could have a security that's quite risky if you held it by itself. If it were the only security that you held, it would be highly risky. But if that security's returns don't move directly and consistently with some other security, then possibly you can put the two securities together and diversify your portfolio and create a lower risk security, a portfolio. This is what mutual funds do, and in lots of situations where diversification can reduce risk. It's absolutely important that you recognize that. And that would be the risk that investors would look at, this diversified risk. That would be measured by this thing we call the beta coefficient that's covered in the chapter, showing how risky a security is in relation to other securities. And we'll also then look at, given the measurement of risk, and that'll be the beta coefficient for common stocks, how much additional return over the riskless rate of return do you require for risk? Those are factors that are
deviation to measure risk, total risk. In total risk, standard deviation comes from Excel file here. And before going to this historical, let me just briefly show you your expected return. basically, when you include more stocks, your this one is the middle one here is variance term, and these are the covariance term. So every time you add one more stock here, you're going to be adding one more variance, but you're going to be adding here several covariances. So if you add one more stock, you're going to be adding here, here, and then you add here is variance, and you add here covariance, covariance, covariance. So you're going to be adding several boxes. Okay? So if you keep on doing that, basically your variance, weightage variance is going to keep on getting smaller and smaller, but you're going to have several weightage covariance. Okay, so just for an example, if you have 100 stocks in your portfolio, you're going to have 100 variance term, but you have 99,100 covariance term, so which is 1%. Okay, so as number of stocks in your portfolio goes up, unsystematic risk is going to be going down. So eventually you eliminate it completely. Only thing left over is systematic risk. So each asset's contribution to total portfolio variance is equal to the sum of these covariance terms. Okay, so an asset's contribution to the risk of well-diversified portfolio is determined by average covariance with other assets, not by its one variable. So well-diversified portfolio, you're going to have only covariance risk left. So that means you have only the systematic or market risk left. We call that covariance risk is market risk. And let's just look this example. If you don't have a portfolio, you're going to have home risk and market risk. If you have one asset, then you have this total risk. Okay, here is total risk. If you keep on increasing number of assets in your portfolio, what's going to happen is you're going to keep on reducing your risk. Okay, and you reduce your all unsystematic risk. Only thing left over is this systematic risk. You cannot diversify systematic risk, but you can diversify, eliminate this unsystematic. So that's the portfolio theory. Portfolio theory says that by creating a portfolio, optimal portfolio, you can eliminate all unsystematic, all company specific risk. Only risk is going to be left over is market risk. So if you have about 25 stocks in your portfolio, you can eliminate most of this unsystematic risk. And only thing left is systematic risk, which you cannot diversify. So according to modern portfolio theory, you can eliminate unique risk, unsystematic risk by creating a portfolio. So with this, we are done with this risk return and the capital asset pricing model lecture series, and see you in my next class. Thank you.